Hello, my name is Carol Sofia Saavedra Villarreal, and today I will explain the basic terms of accounting and how they work. In accounting, each transaction is recorded in accounts. Accounts are classified as debit or credit, depending on whether they naturally increase with a charge, debit, or a credit. Debit accounts generally increase on the left side, debit, and decrease on the right side, credit, while credit accounts increase on the right side, credit, and decrease on the left side, debit. This explains why some movements are recorded on the debit side, such as assets, and others on the credit side, such as liabilities and stockholders' equity. Understanding this is essential because it explains how accounts are affected when a company receives money, pays debts, or makes adjustments. It is important to understand that each account has a normal balance, which helps accountants identify errors quickly. A debit account normally has a debit balance, while a credit account has a credit balance. This principle prevents errors and ensures accuracy in financial statements. In addition, knowing the nature of each account allows the company to plan its cash flow, assess its financial health, and make informed operational or investment decisions. Assets. Assets are resources owned by a company that are expected to generate future economic benefits. They can be tangible, such as buildings, machinery, or inventory, or intangible, such as patents, trademarks, or software. Assets are divided into current assets, which are expected to be converted into cash, sold, or consumed within less than a year, and non-current assets, which are long-term resources. Intangible assets, although they have no physical form, contribute economic value, such as trademarks, patents, copyrights, licenses, internal software, or goodwill. All asset accounts are debit accounts, which means that they increase with a debit entry and decrease with a credit entry because they represent resources under the control of the company. For example, bank accounts increase when money comes in and decrease when money goes out. Cash works similarly, but only records immediate physical movements. Creditable VAT is a liability because it represents tax paid on purchases that can be recovered against VAT charged. Inventory is a liability because it represents merchandise available for sale. Prepaid insurance premiums are also liabilities, as they represent a future economic benefit. Why it is debited or credited? Assets are debited because they represent inflows of resources to the company, i.e., increases in its equity. They are credited when they decrease, such as when paying suppliers. 5 asset accounts. 1. Banks. The bank's account is a current asset that represents the company's available cash in bank accounts. It is essential for recording all transactions that pass through the bank, such as deposits, transfers, payments, collections, and checks. Nature of the account: it is a debit account. It increases on the debit side, left side, when money enters the company. It decreases on the credit side, right side, when a payment is made or money leaves the company. Main function: cash flow control. It allows you to know how much money the company has available in the bank at any given time. Bank reconciliations compares the balance of the accounting account with the balance shown on the bank statement, identifying pending deposits or erroneous charges. Detection of unauthorized transactions makes it easier to discover movements that were not approved or possible fraud. Financial planning helps project future payments, determine cash availability, and organize investments or obligation payments. Example of an accounting entry: cash receipt. The company receives $5,000 from a customer via bank transfer. Accounting entry: debit, bank's $5,000, credit, customer's $5,000. This increases the bank's account, showing that the company now has more resources in the bank. 2. Cash. The cash account is a current asset that represents the cash held by the company, whether in bills, coins, or cashier's checks, available to cover immediate expenses or minor payments. It differs from banks, as cash records cash transactions, while banks records movements through bank accounts. Nature of the account: it is a debit account. It increases on the debit side, left side, when cash comes in. It decreases on the credit side, right side, when a payment or cash outflow is made. Main function: 1. Control of available cash. It allows you to know how much money the company physically has at a given time. 2. Payment of minor expenses. It is used to cover small purchases, office payments, transportation, or unforeseen expenses. 3. Immediate recording of transactions. All cash inflows and outflows are recorded to maintain control and transparency. 4. Security and internal control. Prevents loss or misuse of cash through detailed records and regular checks. Example of an accounting entry. Cash inflow. The company receives $500 for a cash sale. Accounting entry. Debit cash $500. Credit sales $500. This increases the cash account, showing that the company now has more cash. Cash outflow. The company pays $200 in cash for office supplies. Accounting entry. Debit office expenses $200. This decreases the cash account, reflecting that cash was used to cover an expense. 3. Creditable VAT. The creditable VAT account is a current asset representing the value-added tax that the company pays when purchasing goods or services. This VAT is not an expense because the company is entitled to recover it by subtracting it from the VAT it charges its customers, output VAT, when filing its return with the SAT. Main function: 1. Record VAT paid on purchases and expenses that can later be credited. 2. Control the tax that can be recovered, avoiding excessive payments to the tax authorities. 3. Facilitate VAT reconciliation, ensuring that the financial statements correctly reflect taxes payable or recoverable. When it is used, when the company purchases goods, supplies, or services subject to VAT, either in cash or on credit. When a VAT payment is made for advances or prepayments for services. During the monthly or quarterly tax return, it is used to subtract the creditable VAT from the VAT charged to customers, determining the balance payable or in favor. How it is recorded. Example 1. Purchase of goods. Goods are purchased for $10,000 plus 16% VAT, $2,600. Accounting entry. Debit inventory $10,000. Debit creditable VAT $1,600. Credit suppliers $11,600. Example 2. Payment for services with VAT. Payment for a consulting service $5,000, 16% VAT $800. Accounting entry. Debit consulting expense $5,000. Debit creditable VAT $800. Credit bank $5,804. Inventory. The inventory account is a current asset that represents the value of the goods or products that the company has available for sale. It includes all stock that has not yet been sold or consumed in the course of business. Main function: 1. Record and control inventory available for sale or production. 2. Determine the cost of sales when merchandise is sold. 3. Know the value of capital invested in merchandise, helping to make decisions about purchases and production. 4. Avoid shortages or excess inventory, optimizing liquidity and storage. Nature of the account. Debit, asset. Increases with a debit when merchandise enters the warehouse, purchases customer returns. Decreases with a credit when merchandise leaves, sales transfers returns to suppliers. How it is recorded. Example 1. Purchase of goods for the warehouse. Purchase of products for $5,000 plus 16% VAT $800. Accounting entry. Debit warehouse $5,000. Debit creditable VAT $800. Credit suppliers $5,800. Example 2. Sale of merchandise. Merchandise costing $200 is sold. The sale price is $2,000 plus VAT $320. Accounting record of the sale. Debit accounts receivable $2,320. Credit sales $2,000. Credit VAT charged $320. Accounting entry for the cost of goods sold. Debit cost of sales $1,200. Credit inventory $1,200 when the account is used. 1. When receiving goods from suppliers or own production, the account balance is increased. 2. When selling goods, the balance is reduced, transferring the cost to the cost of sales account. 3. When returning goods or receiving inventory adjustments, the balance is adjusted accordingly. Accounting importance. It allows you to know how much capital is invested in inventory. It facilitates purchasing and production planning, avoiding shortages or excess goods. It ensures that financial statements accurately reflect available assets. It is essential for calculating profit margins and profitability. 5. Insurance premiums. The insurance premiums account is a current asset that represents advance payments made to an insurer to protect the company's assets, operations, or liabilities. This includes property, vehicle, civil liability, health, or any other insurance coverage purchased. Main function: 1. Protect the company's assets against risks such as theft, fire, accidents, or damage. 2. Record advance payments that do not yet represent an expense, recognizing them as an asset until the insured period expires. 3. Distribute the insurance expense over the period covered by the policy following the accrual principle. 4. Monitor current insurance policies and expiry dates to plan for renewals and future payments. Nature of the account: debit, asset, increases with a debit when the insurance premium is paid in advance, decreases with a credit as the monthly expense corresponding to the coverage for the period is recognized. How it is recorded: Example 1. Annual insurance payment in advance. The company pays $12,000 for annual insurance. Accounting entry: debit, insurance premiums $12,000. Credit, bank $12,000. Example 2. Monthly recognition of insurance expense. Each month, $1,000 is recognized as an expense. 12 months. Accounting entry: debit, insurance expense $1,000. Credit, insurance premiums $1,000. When the account is used: 1. When paying an insurance policy in advance, the account is increased. 2. Each month or accounting period, the proportional part of the expense is recognized in the income statement. 3. At the end of the fiscal year, the account is adjusted to reflect only the unused portion as an asset. Accounting importance: it allows for cash flow planning and ensures that resources are protected against risks. It guarantees that expenses are recognized in the period to which they correspond, complying with the accrual basis. It helps maintain accurate and reliable information for financial decision-making and audits. It avoids recognizing a total expense at once, which could distort the profit for the period. Liabilities. Liabilities. These are debts and obligations owed by the company to third parties, arising from past transactions, which involve the future outflow of economic resources, money, goods, or services. Nature: they are creditor accounts increasing with credit, and decreasing with debit. They reflect commitments that the company must fulfill, so clear recording is essential. Types of liabilities: 1. Short-term, due in less than 1 year, e.g., suppliers, wages payable, taxes, crucial for daily liquidity. 2. Long-term, due in more than 1 year, e.g., bank loans, bonds payable. They allow projects to be financed without affecting immediate liquidity. Key functions: financial control, knowing how much is owed and to whom. Cash flow planning, anticipating future payments. Legal and tax compliance, recording taxes and obligations. Solvency analysis, assessing payment capacity. Risk management, identifying contingent and accumulated liabilities. Examples of accounting entries: purchase on credit, debit, inventory $5,000, credit, suppliers $5,000, increases liabilities. Partial payment, debit, suppliers $2,000, credit, bank $2,000, decreases liabilities. 5. Liability accounts. 1. Suppliers. Suppliers is a liability account, so it is a creditor. Its main function is to record the debts that the company has with third parties for purchases on credit, mainly merchandise or supplies necessary for the operation of the business. In other words, it is through suppliers that the company obtains the products that it will then sell or use. Its nature is creditor. It increases in the credit column when goods or services are purchased on credit and decreases in the debit column when a payment is made, a discount is applied, or a return is made. For example, if you purchase merchandise for $5,000 on credit, the accounting entry would be debit, inventory $5,000, credit, suppliers $5,000. This reflects that the company now has an outstanding obligation to pay and at the same time increases the inventory of merchandise it can sell.